Once a company is successful, it's really hard to stay at the top. On today's episode of Friends Talk Financial Planning, we're going to discuss why that's the case and what you can do about it in your investment policy. Hi, I'm John Scherer, and I own a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan, Mermel, and I've got a fee-only financial planning practice in Chicago, Illinois. Before we start talking about why it's hard to stay at the top, please hit subscribe. It helps us reach more viewers. So, John, this is all inspired by some information that Dimensional Funds put out about how what happens to companies after they're one of the top stocks. So inspired by our episode about FANG, which is Facebook, Apple, Amazon, Netflix, and Google. It's like, well, what happens when companies are at the top? And so they put together a prediction, or not prediction, but experience about what happens when one company reaches the top. What happens to them after that? So why don't we talk that through?
Yeah, that sounds good. And so let's put up, why don't we just bring up real quickly here the graphic from our previous episode. We'll put a link to it in the show notes too. If you didn't see that FANG episode, it was a really useful one to talk about concentration in stocks and in the stock market and why you shouldn't maybe worry about it as much as the media might tell you to. But take a look at this graphic here going left to right. And the one thing that we talked about last time is on the bottom, that concentration of the top 10 stocks. But let's take a look for a minute at that going across, the following the lines on here. And what Dimensional did with this is they connected the dots in the same colors, and you can see from left to right when companies come in and out of the top 10 this is in the market as far as size goes. And I'll point out that the ones that don't have any lines or arrows, right, just the empty circles, that's when they only made a 1 decade appearance in the top 10. And so it's interesting. One of the things that catches my eye is that back in the olden days, right, 30s, 40s, and 50s of the last century, boy, there was a fair amount of consistency. And this century, the last 20 or so years, a lot of new faces. It'll be interesting to see how those things change and move over time. But we started to point out a little bit that things like AT&T and General Motors, General Electric, you look at where they started almost 100 years ago, not too many of them, maybe none of them are in the top 10 today. And that's that basis. We started looking at it going, hey, well, let's dig into this and talk about this, right?
Yeah. So let's talk about what happens to these top stocks. And right now it's easier just for our own, it's easier to think about the stocks that are happening now versus the olden days of my youth, right? So back then it was AT&T was a big one, and General Electric, two big stocks. Yep. Now, maybe AT&T isn't known as a tech stock also, but I would argue that they were the tech stock at the time. And actually, General Electric, they were getting the light bulbs going and electricity, et cetera. They were actually a lot more like tech stocks back in the day, I think, than we associate them with today.
Right.
The other thing is that I think foreign competition really kicked in at one point. And so I think that's one of the things that has stirred up the pot, because I think after World War II, it was so many countries were just rebuilding that it took a while for them to be even kind of functional enough, like have their bases met for them to be able to compete with the US.
Right. Well, here's one thing, and talk about okay, what companies do they stay at the top? And maybe as we think about those FANG type stocks today is, well, geez, should we just ride that train? And the answer is, maybe. We'll see. But I think AT&T is a great example. Look across the left there. They're on the top decades in a row. Let's not overlook it. We're talking 30, 40, 50 years, one of the top two companies. What happened in the 80s? Then we had deregulation, or the government got involved and broke AT&T up, right? And so one of the risk factors is, government intervention and political winds change, and something that might otherwise be, and we can discuss a separate discussion. Is that a good thing, a bad thing? I don't know, probably a good thing and stuff. But the reality is, that can change that can be an influence on staying at the top for a company as different regulation, especially I would suspect in the tech area.
Well, and how they handle the regulators. I mean, there is a when the market share gets too concentrated, there's a move to say, hey, to take a closer look and say, what are these companies really doing? And are they trying to get this market share by ways that the government, it's either against the law or we don't agree with?
Right.
Thing is, they're just competitors. I mean, hey, if this big company's doing this, like, let us do it,
Right.
so, or we can do it more efficiently. So just being on the top invites competitors.
Right, right. Technology is some things that you didn't have with competition when you were first starting out, maybe, and even for a decade or two, right? You've got that advantage. How does that change over time with things? And how does, that's a risk that comes in. One of the other things that I think about with this is just it sort of gets into a little bit of weeds on some economic theory and things. But the reality is, listen, if I expect to get this kind of return on a stock and the stock is worth $50, and this is the profits in the future. Well, if it goes up to $100 and the profits are at the same level, that means that my returns are going to be lower based on that. As the stock price goes up, it's sort of this perverse relationship. So I'm getting this growth, but then my expected returns down the road, just by definition, aren't going to be as high. And so you get that huge growth on the early years with things. I relate it to, as I describe it to clients, it's an analogy I use goes back to Walmart, who's on our on that chart that we were looking at, is back in the 50s or 60s when there was two Walmart stores. For them to double their growth, boy, it's not too hard to do, right? They can skyrocket. But then what happens if there's road construction in front of one of their two stores when they're first starting out, right? They could also go out of business in a hurry. But as they get now, there's a gazillion stores on every corner in every town, sort of a thing. Walmart's not going to double their sales next year, right? That's just at a certain scale of that. They can't, and as that stock price rises, if the stock goes up, their sales just sort of can't keep up with it. So the expected return doesn't mean it's a bad investment or anything, right? It's just that the expected returns have to go down, and it's sort of this yin and yang relationship.
Yeah. So, I mean, and then we don't even get into the fact of bureaucracies and the largeness of companies can kind of slow them down. It's hard I know, even just adding employees, it makes it more difficult to make changes in my company,
Yeah, right.
a few employees, much less these employees that are huge, so that they deal with that too. Like, so there's a lot of factors that basically drag companies back to the mean or
Right.
drag them back to average.
One thing that just struck me, Bridget, is we're talking, and I tend to focus on the known factors, right? These are things that we can identify.
Right.
I mean, think about the other side of this too, is the unknown factors. And I think of Kodak as one of the, they were the leader in film technology and, a rock solid, one of the companies that you couldn't go wrong with. And then as the digital age came in, they didn't adjust quite fast enough. And basically they've gone away, right? And so you think one of these for
was on the list too. On like same. It would be very difficult for like you kind of feel for the company because it's like, okay, there's this, nobody makes copies anymore,
right?
like
But you think about all these things that we're discussing that are real and accurate, that those are the known risk factors. There's certainly some things in 20 years we'll look back and go, who would have guessed that X or Y or Z came in and took some of those companies that were in the top and made them obsolete if they don't stay up, right? There's all that unknown thing and all that future innovation that we just don't know what it even looks like.
Right.
And then I wanted, one of the things I sort of morphed a little bit into, hey, what are these large companies? How do they stay there? And sort of talking a little bit about returns. And I do think it is interesting. Maybe we'll pull up another graphic here that Dimensional had provided and you can take a look at what the returns after a company gets into the top decade here. And it goes back to 1927, right? So we got a long time horizon.
You mean the top 10?
The top 10. Yes. Thank
Okay.
you. Thank you. It goes back a long time. And you go, listen, once they get in the top 10, hey, they're doing pretty well. But then over 5 and 10 years, look at those returns or the excess return they're talking about, but they're outperformers in the early stages. Hey, they're on the upswing, but they're actually on average underperformers longer term. Right. And so what does that mean for the FANG stocks? I don't know. I mean, history says that maybe we'd expect some underperformance. It'll be interesting to see, but it's not like those things keep on rolling. And as we talk about large company stocks and where they are, that's all nice and interesting. But at the end of the day, we want to know, hey, what are we getting from these things? And this return, I think, talks a little bit about that.
Well, and I think our overall message is about diversification. So having a broad basket of everything helps lower your risk and capture the high flyers that we don't even know they haven't even formed yet.
I love that idea. We don't even know the future, so diversification captures them all. It's a great place to wrap things up here. Again, I'm John Scherer. I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan Mermel, and I've got a family financial planning practice in Chicago, Illinois. John and I are both taking clients. We see clients all over the country, but if you're interested in a advisor in your local area, we're both proud members of the Alliance of Comprehensive Planners, which is a not-for-profit group. We're all tax-focused, comprehensive financial planners. And the other thing I urge you to is please subscribe.
That's right.